Welcome back everybody for another video. In today's episode, we're going to talk about how to invest for beginners. We're going to go through everything from start to finish. It's going to involve a little bit of why we invest, including inflation, the dreaded inflation. I hate this stuff. I think everyone hates this stuff. By the end of this, you should feel confident enough to go out into that world and start investing. Put your first little £1 in. Start small and work your way up. I hope. Anyway, if that doesn't work, then I have not done my job properly, and comment below and I will do whatever I can to actually help you. Now, to start with, if you made it this far, that means that the chances are you really want to get a grip on your finances and start investing. So what I need you to do for me to help you is to subscribe below, hit that little subscribe button. Okay, there's a little bell on there as well, so you get notified when I actually post a video, and then you'll know when I post different tips and tricks, and it will help you to invest in the long term. So please make sure you subscribe, because it will help me keep this channel going. So let's get stuck in and start with the very basics. Why does money lose value over time? Bet you didn't know it loses value over time, but it does. Money loses value. So here it is. Money does actually lose value over time. And this is because of a really evil thing called inflation. No one loves inflation, but it happens globally. Every country has to deal with inflation. And this is because the price of goods goes up, whilst the value of the pound or the dollar or the euro stays exactly the same, okay? Now let me give you a little example. Everyone needs an example to help visualize how this works, okay? So I have here a loaf of bread. Yes, it's a bloomer. I think it's a bloomer. I went to the bakery and I asked for a loaf of bread and they gave me this. And I used to work in a bakery and bloomers used to be the thing. But anyway, I have a loaf of bread. Here it is. So back in 1980, this wonderful, oh God, this smells so good. I've got to eat this after. This loaf of bread used to cost 33p. 33p for a loaf of bread. Oh, it's fantastic. But if you fast forward to today, this same loaf of bread costs £1.37. What the hell? That is one expensive loaf of bread. It's like gold dust in my hand. I'm just going to collect them. So the point is, salaries may increase, but they don't necessarily keep up with the cost of inflation. So as the cost of products like this bread here go up, your pound stays exactly the same. So essentially that pound is losing value. I'm just gonna hold, I don't know what I'm doing with this. I don't know why the hell I'm just holding this loaf of bread. So let's break this down further, just so you understand. My girlfriend's a celiac, she's gonna be furious with me. Bread everywhere. So what exactly does this mean for you? So back in 1980, for £1, you would have been able to buy three loaves of bread. 3. Fantastic. But as the years went on, the cost of bread increased. So by 1990, get rid of that one, you could only have 2 loaves of bread for the same pound. And by the year 2000, still, 2 loaves of bread. There wasn't a lot of inflation around them. And then by 2010, see you later, 1 loaf of bread for £1. See where I'm going with this now? And then get this, by 2023, at £1.37 for a loaf of bread, it wasn't even the whole loaf. You could have like, oh, I can't tear this. My girlfriend would be furious getting the gluten everywhere. But about half a loaf of bread, okay, for the same amount of money, which kind of sucks. So basically, bread is expensive now. Just like everything else, it sucks. And that is one of the main reasons why we invest. We invest because as our money goes up in our investment account, we can actually add value to that pound. Man, I'm gonna eat the hell out of this loaf of bread after. So good. Oh, that's fantastic. Oh my God, there's gluten everywhere. She's gonna be mad. She is gonna be absolutely mad. Oh, I'm covered in stuff. So this is why saving money, you need to save some money. Everyone needs a little bit saved, okay? I have a safety net. I think everyone needs that, right? But this is why if you save your money and you don't invest your money, you end up losing what you call your purchasing power over the years. So this is step number 1 as to why we invest. Step number 2, people. Woohoo! Step number 2, how do we stop inflation from eating into our savings? So there are two ways that we can stop inflation from eating into our money, our hard-earned money. One of these is, yes, a savings account, but you need to choose the right one, and we'll come to that a little bit later on, okay? But on average, a savings account is around 2.59% on average. So let's just say that we put £1,000 into a savings account at 2.39%, okay? Over 10 years, you'd have around £1,291 from that savings account. Yeah, it's not bad, but you can do so much better than that, okay? So here it is. If you took that money and you put that into the S&P 500, ooh, what a powerful ETF, I love it. You can look at around 8% on average per year return. So that 1,000 would turn into 2,150 over a 10-year period, significantly better than a savings account. Now, as I said, I am not telling people not to save. Everyone should save, and once again, we will come to that shortly. But an investment account will grow your money a lot quicker over the long term. So, let's look into some of the best savings accounts and some of the best investment accounts. So there are three that I like to use. Number one is CHIP. CHIP has a 3.75% AER every year. Okay, so you can look out on 1,000, 3.75% return every year on that 1,000. Another great one that I love to use is Monzo. I have a Monzo bank account, so it's easy for me to just shift my money from my current account straight into my savings. That is currently sitting at around 3.6% AER. Now remember, these are all what you call variable, so they can change, but they are the best ones that I'm personally using. And then the third one is actually Trading 212, the investment account. Trading 212 are a broker where you can go and invest, but any money or any cash in that account that you're not investing, they give you interest on. That is currently sitting at 4.9% AER. So I have some of my money in my Monzo saving account, and I had some separately in CHIP. I'm now moving that back over to Monzo just because it's easier to have it all in one location. And then I'm gonna have excess money in my Trading 212, okay? Because of that 4.9% AER. It's fantastic, why wouldn't you want that? So moving to one side away from the savings and moving into the stock market, you've got three different areas you can invest in. One, you have ETFs. Love an ETF, absolutely love an ETF. Then you've got bonds, which I don't love. I'll be honest with you, they're very safe. Bonds are very safe, but they're boring and they're slow. And I don't see the point in them, personally. And then you've got your stocks. These are where you invest in individual companies. Now, you're going to get a much higher return when you invest in an individual company over an ETF or a bond, okay? But they come with a lot more risk, and you need to do what you call your fundamental analysis on these stocks. And I will create another video on that soon that will show you what to look for, how to read a balance sheet, and how to understand if it's a good company or a bad company, because you need to invest in a company that's growing. It's got some power behind it. So, the big one. There are some critical steps you need to take before investing. These are the two things you must do before you invest. Fact. If you're not doing this, you are doing it all wrong. Some people might hate me for what I'm about to say, but it's the honest truth, okay? Number one, pay off your debts. Oh, I had so much debt when I was younger. I had so much debt. HSBC ruined me. I got charged £70 a week for going into my overdraft. It sucked. It took me years to get out of that, but I did get out of it. Credit cards, the epiphany of evil. They are horrible things. Be careful with credit cards. The fact is, if you are not paying off your debts, then you should not be investing. And the reason why is, if you take a credit card, for example, okay, the average yearly on a credit card is around 20%, okay? Amex, one of their credit cards is 80% a year, 80%. That's disgusting. So if you want to invest in something like the S&P, which might have an average yearly return of, as we said earlier on, 8%, but you have a credit card that you're paying, say, 20% on, why are you investing? Pay off the credit card first. That should be your priority. Pay off the credit card, clear your debts. It will take time. It took me time. I think it takes everyone time. But this should be your number one priority. And I promise you, if you clear your debts, the weight that is lifted off your shoulder is glorious. Oh, glorious. It felt so good when I first did it. So here's a simple strategy that you can follow to clear your debts off, okay? Number one, list them all down from the biggest debt that you have to the smallest debt. It's a horrible thing to do because when you put it on paper, it becomes much more real. Then focus on the high interest debt first. So if you've got a debt that's 20%, okay, focus on that. If you've got another one that's 10%, focus on that last. 20% first, remove it. Get rid of it as quickly as you possibly can. Then you move down to the next one, okay? This is a snowball effect. It's all that money you're putting into the next and the next and the next and the next, and you're just gonna keep going until you've got nothing left, okay? If this takes a year, then it takes a year. Allocate a small percentage of your monthly income to paying off that debt, and then stay away from credit cards. Credit cards could be amazing for building your credit score, but only if you know how to use them. And a good way to use a credit card is to buy things on it for the month and then pay it off at the end of every month, okay? Clear it every single month. I used to do that all the time. And then lastly, any extra cash that you have, I know you are going to want to use it to buy fancy, nice things. I used to do that quite a lot as well when I was younger. But use that to pay off the debt. Just bang, get it done, get it out the way. Trust me, you'll be thanking me afterwards. It's worth it. Now, once you've cleared your debts, you then need an emergency fund. This is so crucial for investing, so crucial. I remember years ago, I got let go from my job. It was very sudden because of a tech crash, basically. And I was very lucky that I had around 6 months worth of money in my account to help me live, okay? So they always say 3 to 6 months worth of emergency funds just to keep you going in case of emergency. So please, God, make sure you do that. Allocate whatever you can. Allocate what you were doing to pay off your debt to your emergency fund and save as much as that's possible, just for a rainy day. Now, if you follow these 2 steps to start with, you are now ready to invest. You're ready to get stuck in. Ooh. So that brings us on to the next section. Number 4, how do investors make money? You have 2 forms of investment. You've got number 1, which is capital gains. So if you buy a stock at £50 and that stock goes up to £100, you then sell it and you make £50 extra, £50 profit, right? That's your capital gains. Yes, it can obviously go down, but if you're investing for the long term, it will rise back up if you picked a good stock and you won't have to worry about those fluctuations in the market, okay? Second, dividends. I love dividends. That's why this is called the dividend drip. That's what I'm working on now. Dividends are where a company pay you a small amount of their profit as a thank you for owning their stock. Okay, it's like, oh, I thank you very much. You have some of our stock, have some of our profit. Oh, I thank you. I really appreciate that. Ha ha ha. That's how that works. Okay, so you can have your capital gains and you can have the dividends. The great thing about dividends, it doesn't matter what happens with the company going up and down stock wise and their price, you're still going to get paid your dividends. Now, some companies, they pay a little bit more on the dividends and a little bit less depending on the decision at the end of every quarter. So they pay dividends every quarter, okay? But the fact is, if you pick a good stock, you will still get paid your dividends. On to our 5th section. What exactly is an investment? It's not just investing in the stock market. There are lots of different investments, but some of the more common ones. Yes, investing in the stock market. 2, property. Everyone in the UK loves to invest in property, and the US, but the UK especially, okay? Buy a property, renovate it, rent it out, live off that monthly income. Fantastic, everyone's happy. Thirdly is then building a business. If you build a business, that is an investment, okay? I would say arguably running a business is much harder than owning property and renting it out and the stock market, but it can be much more rewarding. What I will say to everyone out there that wants financial freedom and to not be in a full-time job, running a business is not easy, okay? If you think that you are going to set up a business and still have your holidays and your Christmas, it's not going to happen, okay? You will probably have a more peaceful life in a full-time job than you will running your own business, but the rewards are fantastic and you do have your freedom to be your own boss, and that's a wonderful feeling. So if you have the mindset for that, get stuck in and run your own business, okay? But what I will do is another video on how to find the right career for you and how to get those salary increases as well. So look at Jeff Bezos. Bozo. I'm just gonna call him Bozo. Mr. Jeff Bozo. He set up Amazon in around 1999. And look at this picture of Jeff in his office. Look at that logo up on the wall. I think he spray painted it. He just spray painted Amazon.com. What an absolute legend. Man, how that guy has changed. Look at the picture of him now. He's got muscle to him. What the hell happened? That's money for you. That's a lot of money. Turned from a geek to an absolute beast. Unbelievable. And finally, here it is. This is the best investment you can ever make. Number 4 in investments. The biggest investment you can ever make is in you. Yes, I said it. You right there. Look in the mirror. Turn around, find a mirror, look in it. You are the biggest investment you will ever make. You can invest your money in stocks, into a business, into property. It doesn't matter. You're the one that needs to have the knowledge to do that. So pick up a book and read a good book. Watch YouTube videos like the one I have going right now, which I will release many more of. Talk to friends, learn from them. You should be doing whatever you can to learn how to invest and how to make money if that is really what you're interested in. Learn a new topic or a new subject. This is what you need to do. If you are not learning something new every day, even one little thing, you are missing out on a huge amount. You are your biggest investment. Fact. Done. Oh, I feel good now I got that on my chest. I need to tell more people with that. Invest in yourself, man. Now we're moving towards the end. Okay, relax. We're getting there. Soon I will show you exactly how to put your money into an account. So number 6, what are shares? Now I want to teach you this because I think it's really important. Like with a company, right? If you're going to invest in the stock market, you need to invest in a company you understand. You need to research the company. And I feel like if you're going to invest in the stock market as a whole, you need to know what the hell a share is. Where did it come from? How is it created? If you don't know that, why are you doing it? Know these things. As I said, invest in yourself, build your knowledge. When you buy a share, you're essentially buying a very small piece of that company. So essentially, as you own that share, as the company builds and grows and gets bigger, like Mr. Bozo and his Amazon, your wealth will grow as well. That share that you got for 100, if it turns into 1,000, you're going to make a 1,000% increase. So if that business builds and grows, your share will increase in value, right? That's why you need to find companies that have a lot of future potential, because it's going to help benefit you and your wealth, right? But here's the fun fact. You can own that share, okay, and watch it grow, but it gives you more than that. It actually gives you the right to vote in what happens in a company. So brokers like eToro, as a perfect example, that's someone that I use for my investing. eToro will send you an email to say, hey, look, you've got some shares in Amazon. You can actually vote on what happens in the company. Fantastic. Do I do it? Sometimes, just for fun. It depends on what the company is that I'm investing in, but sometimes I do vote. But if you're a novice investor, you don't have to take any interest in this at all. It's more for you to have your say or your rights if you really want to. So, the big one. If you want to understand what shares really are, we need to take a step back in history. We need to go back in time. And I'm going to show you a quick clip, and this might interest you a little bit more. I love this movie. I absolutely love this movie. Here it goes.
Shoot him!
Father! What? Commodore, do you really intend to kill my rescuer?
I believe thanks are in order. Had a brush with the East India Trading Company, did we? Pirate? Hang him! Keep your guns on him!
So you may have heard him say to Mr. Jack Sparrow, the East India Trading Company. That is because the Dutch East India Company was the first company to ever issue shares, and that was back in the 1600s. So why did this happen? Okay, here it is. So back in the 1600s, they used to use ships to travel the world and the 7 seas. Everybody's looking for something. Anyway, they used to travel across the seas. Explorers used to go on these voyages to find new trade routes. So they used to take a lot of spice and a lot of gold and a lot of silk. And these were really, really, really dangerous. Quite often, the ships would end up sinking in storms and, like Captain Jack Sparrow, pirates used to rob them of all their stuff, okay? So because this happened, this became really, really expensive for the Dutch India Trading Company, okay? So what they did was they said to the locals, if you invest in these voyages, we will give you some of the profits. Now, ultimately, this was a huge success because it's carried on for the last 400 odd years, okay? And this is essentially how it started, all from voyages across the sea. And a fun fact, the Dutch East India Trading Company was the first company to ever import tea into Europe. So you have them to thank for your wonderful British cup of tea. So there it is. There is the history of shares and how they became real. Now, we've got the boring bit out the way. I know you didn't want to have to listen to it all, but it's something you have to hear. Now we can move into the fun bit. Probably the bit you've been waiting for this whole thing. So buying shares is so easy in this day and age. It's unbelievable. Thank you, technology, for making life so easy for us. All you need to do is open a brokerage account. There are two that I use. One is Trading 212. The other is eToro, okay? Both have slightly different fees. If you're in the UK, eToro is mostly free. Both of these have something called a spread. I'm not going to go into that. It will not affect you. They're so minimal and you don't even know the spread has been taken out. It's pointless to explain right now. I will do a more advanced video on that in the future. Trading 212, you can invest from £1, just £1. You can have £1 of Apple. You can have £1 of Nvidia. You can have £1 worth of Amazon if you want to. There is no excuse for you not to buy £1 worth of stock in something, okay? The other one is eToro, but eToro is a minimum of £10 to buy a share, okay? But equally a fantastic platform. And I will be launching a video on both of these brokerages in the next few weeks, so bear with me. I'm still working on creating that one and gathering the info from their website. Ooh, that's gonna be a fun one. You know, compare the two. And I use the two, so I wonder if the loser will still sponsor me. I need to be careful with this. So what do you do when you open a brokerage account? What next? Where do you go? What do you do? What do you buy? Who knows? The world is your oyster. But I can point you in the right direction. If you're a beginner, stay away from stocks. Individual stocks. Don't buy a company stock. There's really no point in it because you're not at the point where you understand fundamental analysis and what to look for. Do not follow trends. If your friend says, oh my God, I'm buying Nvidia, it's amazing, stay away from it. If you follow trends, you can get yourself into trouble because if it's a trend, the likelihood is you're already too late to the party and you'll buy at the top of that trend and it will plummet back down again. So the best thing to do is invest in what we call an ETF. That is an exchange traded fund. An ETF is essentially a bucket of loads of stocks, all in that bucket. So you invest in the ETF and it divides that up into all those stocks. It's fantastic. It makes life so easy. So just go ahead and do that. Now you might be asking, what ETF do I invest in? Because I can tell you now there are thousands of different ETFs out there. But once again, I can point you in the right direction, okay? Now this is not financial advice. Please do remember that your capital is at risk. Absolute fact. I know this, everyone knows this. I have to say this, okay? But these are the 3 ETFs that I invest in. Number 1, the S&P 500. Now you're gonna see here, right here, it's got an ACC next to it. You might be saying, what the hell is ACC? ACC is accumulator. So with an ETF, you receive dividends. An ACC, an accumulator, will mean that when those dividends are received, they are reinvested into that ETF. That's what you want. You want the dividends to be received and then you want them to be popped back in there. Thank you very much. Keep reinvesting. That is how your compound interest works. So look for the ACC on the end of an ETF, okay? What is the S&P 500? The S&P 500 is a bucket of the 500 largest companies in America in technology, okay? They're big tech companies. Biggest 500. Fantastic. Technology is what the world we're living in right now. So it makes perfect sense to invest in them, in my personal opinion. It's a safety net. Can it go down? Yes, it can. COVID brought that down by around 39%. So if you had 1,000 in there, you would have been down £390. But do not panic, because it is now back up, way up from where it was, okay? It always recovers, it just takes time. You only lose money when you sell. Fact, okay? So stick with it and just let it run, let it run, let it run. The second one is the iShares Core MSCI. This is also stocks from the US, but they're small and medium cap. So the S&P 500 is large mega caps like Amazon's and Apple. The MSCI is more small cap, mid cap, like Abercrombie and Fitch, for example. You know, they're much smaller companies, still got a good profit, but much smaller. You will find this is a much more volatile ETF, but still a fantastic one to get involved with. And it diversifies. You don't want to be solid into the big tech. You want some smaller companies that could potentially grow in the future as well, okay? And then thirdly, you got the VTI. This covers everything in the US market. It's a huge bucket, okay? It's a much more steady growing ETF, but it's also a lot safer. So get some money in that as well. Those are the three that I would personally invest in, okay? They're the three that I have money in, and it grows very nicely. I'm very happy. It takes time. You're not going to become a millionaire overnight, okay? Let's just make that clear. But if you're doing it now, it will benefit you in the future. So we're on to the next step. Ooh, this is an interesting one. Is investing risky? Yeah. What isn't risky? Every investment is risky. Absolute fact. Your capital is always at risk. If you put your money into the stock market, there is a chance that money can go down. If you buy property to rent out, there is a chance that something could happen to the property, or the property market will crash and you'll lose money. If you buy a business and you put loads of money into the business, there is a chance that that business will not work out and you'll lose your money. There it is, fact. Investing in the stock market is exactly the same, okay? You just have to be patient and stick with it. Now, there is a way to help with your emotions when it comes down to investing, and that is called following a DCA strategy. What does that stand for, Oliver? That stands for dollar cost averaging. Let's jump to this slide and I can show you exactly how that works. So let's imagine you buy £50 worth of Google, okay? The stock starts to drop, the price goes down, okay? You don't panic. You have money in reserve. You always have cash in reserve. You then buy another £5 worth, not 50, £5 worth of Google. And it keeps going down by, say, another 5 to 10%. Then you buy another £5, okay? You keep doing this and you just invest weekly, monthly, whatever you're more comfortable with. And over time, you'll buy that stock at different prices, okay? So it will create a really nice balance. This is a much easier way of investing. It removes a lot of the emotion. So trading 212 is very, very, very good for this. It allows you to automate your DCA strategy. So basically what you do is you say to trading 212, I want you to invest £5 per week into the S&P 500. And it will do that automatically. You don't have to do anything. You set it, you forget it. That's dreamy. That removes all the emotion from the situation. You come back 2, 3, 4 months later, I promise you, you will check it more than that. Everyone does. But you come back to it, you check how it's going, and you just leave it to do its thing. And you do that for 10, 15, 20 years. And I promise you, you'll have a bucket full of money in there. Now, there are a mixture of reasons why I choose to follow a DCA strategy. Firstly, and most importantly, it encourages discipline in investing. It is consistent. And investing is all about consistency. Absolute fact. Don't stop, just keep doing it. Another one is that it removes the emotional stress. So many people panic. When the stock goes down, they naturally sell because, oh my God, it's 10% down, I'm losing money, end of the world. Nightmare. So that also removes that problem. Another one is that it mitigates the downside risk, okay? So as it's going in, you'll buy more. When it goes back up, you'll make money quicker. And best of all, it's accessible for all budgets, okay? You don't have to invest a lot. You do it weekly, you set it, you forget it, you move on, you live your life. You have a very happy time knowing that your money is being very well invested, okay? coming on to number 11. We are near the end of the video now. Fantastic. When do I start investing? Now. Yesterday, as soon as you can. Warren Buffett started investing at around the age of 11, and his famous quote was, "I wish I started investing sooner." I mean, fantastic news. So if you can invest now, go for it. So there's a very famous saying in the world of investing, which is the best time to start investing was yesterday, but the second best time is today. It is never too late. Doesn't matter how old you are, okay? You can still get involved. Yes, if you were 20 and you were putting in £20 a week or £20 a month into the S&P, you'll be much better off than someone that's 40. But even at the age of 40, you can still start investing now. Fact. So get going, do it. Don't hang around, open up a brokerage account and give it a go. Just make sure you are putting in money that you do not have to have, okay? You should always invest with money you don't necessarily need at that point in time. It's a long-term goal, so prepare for that. So, Ollie, how much money can I make? It depends on the market. No one knows what's going to happen with it. But to give you a bit more guidance, okay? Imagine you are investing for a 10-year period. You put in £100 to start with, and then you dollar cost averaged, yes, DCA, what we mentioned earlier on, £50 per month into, say, the S&P 500. Now, this would come to a total of £6,000 invested over a 10-year period, and you would come out with around £11,129. So you would have a profit of £5,129 over a 10-year period. I would say that was pretty good for £50 a month. Why not? If you can spare the £50 a month to make that profit over a 10-year period, do it. Too many people think about making money right this second. I get it. Everyone wants money now, but still invest for the long term. You have to start preparing for that, okay? You will thank yourself in 10 years, 100%. Moving on to number 12. Ooh, how much money do I need to invest? Start small. Small, people, small. It's okay. You don't have to invest with millions of pounds or hundreds of thousands of pounds. The really big misconception in the world is that you need to be a millionaire to invest, and you don't. As I mentioned earlier on, trading 212, you can invest with as little as £1. It's easy. eToro, £10. It's easy. It's not difficult now. But start small. Build your confidence. If you're not sure, you can go to Trading 212 or eToro and you can set up a virtual account. A virtual account will allow you to play with £100,000 in just toy money, okay? It doesn't exist. You don't have to use 100,000, you can lower it if you want, but it comes with that, okay? So get stuck in, have a play around, and understand how the platform works before you actually put your own money in. If you want to do that, hell yeah. I did that for like 3 years, and it helped me a lot. One other thing I want to touch on very briefly are the fees from Trading 212 and eToro. Now they differ. Which one would I go for? Personally, I love eToro for the community. It's fantastic. I love talking to the people on there and seeing what they're doing, looking at what they're trading. It's amazing. Trading 212 I use as well for the dollar cost averaging into, as I said earlier on, things like the S&P. It's really useful. The deposit fees in Trading 212 are free up until £2,000 and then 0.7% afterwards. That does suck, but if you're putting in up to 2,000, it's absolutely fine. Even with eToro, there is a small fee on there as well, so prepare for that. If you're in the UK, it is free to trade stocks on eToro, okay? It's also free to trade ETFs like the VU, what I mentioned earlier on. I say the VU, the ticker is called the VU, but it's the S&P 500. ETFs are free to trade on eToro, okay? Absolutely fine. If you are outside of the UK, eToro will charge you $1 to $2 on a buy and a sell for a stock. Beware of that. So if you're in the UK, absolutely fine. If you're outside the UK, you will have to pay to buy that stock, essentially. If it's an ETF, you don't have to pay for it. Free. Fantastic. Love it. Trading 212, It's free. There's a 0.15% on the currency exchange. So if you're buying stocks in the US, you will be charged an FX fee, a foreign exchange fee. Now it's 0.15%. I don't want to go into that into too much detail, but what I would say is if you are starting out, trading 212 can be a really good starting point, okay? So I would maybe do trading 212 because you can invest with a very small amount of money, and you can use eToro for the virtual account and build up to that if needed, okay? What I will say is the fees on eToro only came into play, I think it was middle of 2024. I cannot say that that will not start to impact the UK in the future. Who knows? So do prepare for that, okay? So, let's do a quick recap, everyone. Recap. 1, pay off your debts. Really important. 2, build an emergency fund. You have to have an emergency fund. Everyone needs it just in case. 3, start small. Everyone needs to start small, man. Just get in there and just do a little bit at a time and build your confidence and work your way up. Number 4, diversify your portfolio with ETFs. Mine are focused on the US market, but that's because I believe in the US market. It's a growing beast and I don't think it's going anywhere. But if you want to invest in the UK market, which is the FTSE, you can do that as well. Number 5, use the DCA strategy. Use dollar cost averaging. It will help you psychologically so much more. Don't put in £1,000 and then when the market starts to drop, you go, oh my God, I don't know what to do. Put in 100 and put in 50 every month over a 12-month period or something. So much easier, so much nicer on your brain. So do that instead. Number 6, stay consistent. As I said, use DCA. You can use the Trading 212 automated investment thingy-majiggy where it just puts the money in for you. It's fantastic. So set that up. And number 7, probably the most important thing, think long term. Trading is not a get-rich-quick scheme, or investing isn't. If you day trade, you can, but don't, please, God almighty, stay away from it. Investing is long-term. So prepare to keep your money in there for a long time and keep it consistent. Now that's all of it. That's everything in a wrap. If you've got any questions, comment below and I'll help as much as I possibly can, okay? But you now have everything you need to really get started, from the history to what they are to the basics of just opening a brokerage account. I will be releasing a video very soon digging into Trading 212 and eToro, how to open those platforms and how to navigate the platforms as well, okay? They both have a beautiful user experience on there, really simple to use, but I will gladly show you all how to do this. So any questions in the meantime, do comment below. And don't forget, subscribe. Please, God, subscribe to this channel. I need as many people to subscribe to this as possible. Let's make 2025 your year to start making some money, become rich. I'm gonna leave you to it now and go and eat my bread. I've got a lot of bread sitting here. So take it easy. See you in the next video, everyone.